Did you know a single percentage point change in interest rates can cost you tens of thousands to over $100,000 on a typical U.S. home? Most people think a slightly higher rate just means a slightly higher monthly payment, a minor inconvenience. But this isn't about a few extra bucks a month. It's about a fundamental shift in your total wealth, your buying power, and ultimately, whether you can even afford the home you've been dreaming of. We're not just talking about the monthly payment here, but the hundreds of thousands of dollars that disappear into thin air over the life of your loan. This isn't theoretical. This is real money that could be in your pocket, invested for your future, or spent on your family. Stick around because I'm going to show you exactly how this happens, and more importantly, how to avoid this costly trap and secure your financial future. Let's put some concrete numbers to this. Imagine you're looking at a $400,000 home with a 20% down payment, so you need a $320,000 mortgage. If the interest rate is 5%, your principal and interest payment would be roughly $1,717 per month. Over 30 years, you'd pay back about $618,120. Now, what if the rate jumps to 6%? Your payment balloons to $1,919 per month, an extra $202 per month. That might not seem like a huge difference, but over 30 years, your total payback is now $690,840. That's a staggering $72,720 more out of your pocket for the exact same $320,000 loan. And that's just a 1-point jump. What happens if rates move even more, or if your loan amount is higher? The impact is truly astounding, and it doesn't stop there. The most immediate and often overlooked impact of rising interest rates is on your buying power, or how much house a lender will actually let you buy. Lenders calculate your maximum loan based on your debt-to-income ratio, and your mortgage payment is the biggest piece of that puzzle. If your monthly budget for principal and interest is, say, $2,000 at a 5% rate, you could afford a mortgage of about $372,600. But if rates climb to 6%, that same $2,000 budget now only qualifies you for a mortgage of about $333,900. That's nearly a $38,700 reduction in your buying power, meaning you have to look at homes in a significantly lower price bracket or come up with a much larger down payment. This isn't just about paying more. It's about being locked out of homes you could have afforded just months ago, which leads us to the critical role of your monthly budget. Understanding your monthly budget is key, not just the total cost. Let's take that $400,000 home again. We saw a 1% rate increase added $200 to your principal and interest. But remember, your actual monthly housing payment also includes property taxes, homeowners insurance, and potentially HOA fees and private mortgage insurance, PMI. These fixed costs don't change with interest rates, but the mortgage payment component can drastically strain your budget. If that $200 extra pushes you past your comfortable spending limit, you're forced to make concessions elsewhere in your life, or more likely, buy a less expensive home. Many people focus on the sticker price of the house, but the true cost is in that consistent monthly outflow. This is where many prospective buyers get caught off guard, not realizing how quickly a comfortable payment can become a burden. But what if you're already in a home and rates change? Here's a common myth. Refinancing always saves you money if rates drop. While lower rates can certainly be beneficial, it's not always a guaranteed win, and holding out for a perfect rate can be a mistake. Many homeowners waited too long to refinance during periods of historically low rates, only to see them climb back up. The decision to refinance involves more than just the current rate. You also need to factor in closing costs, which can easily be thousands of dollars. If you refinance a $300,000 loan at 0.5% lower, but pay $5,000 in closing costs, it could take years to break even on those fees. Plus, you often reset your loan term, potentially stretching your repayment period longer. It's a calculation, not an assumption. Always run the numbers carefully and be aware of the timing because the market can turn quickly. And speaking of timing, what if you want to buy down your rate? This is a strategy often called buying points or mortgage points. Essentially, you pay an upfront fee to the lender at closing in exchange for a lower interest rate over the life of the loan. 1 point typically costs 1% of your loan amount and can reduce your interest rate by about 0.25%. For that $320,000 loan, 1 point would cost you $3,200. If that drops your rate from 6% to 5.75%, your monthly payment would go from $1,918 to $1,869, saving you $49 per month. It would take roughly 65 months, or about 5.4 years, to break even on that $3,200 cost. This can be a smart move if you plan to stay in the home for a long time, but it's not for everyone. You need to have the upfront cash, and you need to calculate your break-even point carefully. So, is it always worth it? Not necessarily, and here's why. Here's what happens if you make a mistake with points. I once saw a buyer pay 2 points, or $6,400, to drop their rate by 0.5%, saving them about $95 a month. They were convinced they'd live in the home for decades. However, just 3 years later, they received a job transfer and had to sell. They had only saved about $3,420 in interest, meaning they lost nearly $3,000 on the points they bought. They would have been better off keeping that $6,400 in their pocket or using it for a slightly larger down payment. The lesson here is crucial. Only buy points if you are highly confident you'll stay in the home longer than your break-even period. Otherwise, you're essentially throwing money away. It's a calculated gamble and one many homeowners get wrong, leading to thousands of dollars in losses. But what about the types of loans and how they handle rate changes? The type of mortgage you choose plays a huge role in how interest rates affect you. A fixed-rate mortgage, like the popular 30-year fixed, locks in your interest rate for the entire loan term. Your principal and interest payment will never change, regardless of market fluctuations. This offers stability and predictability, which is often preferred by homebuyers. On the other hand, an adjustable rate mortgage, or ARM, offers a lower initial rate for a set period, like 5 or 7 years, after which the rate adjusts periodically based on a market index. While ARMs can offer lower initial payments, they introduce significant risk. If rates go up, your payments can skyrocket. Most people shy away from ARMs due to this uncertainty, but they can be a strategic choice in very specific, rare situations. However, for most buyers, the stability of a fixed rate is priceless. What about other loan types like FHA or VA? Even with government-backed loans like FHA and VA, interest rate dynamics still apply. FHA loans, popular for first-time homebuyers with lower credit scores or smaller down payments, are still subject to market interest rates. The same principle of higher rates leading to higher payments and reduced buying power holds true. The same goes for VA loans, which offer incredible benefits to veterans, including no down payment requirements. While the government guarantees these loans, the interest rate itself is set by the individual lender and fluctuates with the market. So, while these programs make homeownership more accessible, they don't shield you from the fundamental impact of changing interest rates. Understanding this is key because it means even with a great program, you still need to be a savvy shopper, and that's where comparing lenders comes in. This is perhaps the most actionable advice. Seriously shop around for your mortgage. Many people get pre-approved by the first lender they talk to and stick with them, often leaving thousands of dollars on the table. Even a 0.125% difference in your interest rate can save you significant money over 30 years. Contact at least 3 to 5 different lenders, big banks like Chase or Bank of America, local credit unions, and independent mortgage brokers. Get a loan estimate from each, which is a standardized form that makes comparison easy. Pay close attention to the interest rate, closing costs, and any points. Don't be afraid to use a competitive offer from one lender to negotiate a better deal with another. This isn't just about finding the lowest rate. It's about finding the best overall deal for your specific situation. The difference can be thousands of dollars, so don't be lazy here. Your future self will thank you. But what if you're not ready to buy yet? The age-old question. Should I wait for rates to drop, or buy now? There's no crystal ball, but understanding the trade-offs is crucial. If you wait and rates drop, your monthly payment will be lower, and your buying power will increase. However, if rates continue to climb, or if home prices rise significantly while you wait, you could end up in a worse position. Remember, home prices and interest rates don't always move in sync. Sometimes, lower rates ignite buyer demand, driving prices up. Sometimes, higher rates cool demand, but prices remain sticky. Trying to time the market perfectly is nearly impossible. Focus on what you can afford comfortably today at current rates. If it's a good time for you personally to buy, and you find a home that fits your budget, don't let the fear of future rate changes paralyze you, because the alternative, renting, has its own hidden costs. While renting might seem like a safe haven from interest rate fluctuations, it has its own set of hidden costs and missed opportunities. Every dollar you pay in rent is gone forever. It builds no equity, no wealth for you. You miss out on potential home appreciation, which can be substantial over the long term. You also miss out on tax deductions for mortgage interest and property taxes. Furthermore, rents themselves are not immune to inflation or market demand, often increasing year after year with no cap. While homeownership comes with responsibilities and risks, it also offers the potential for significant wealth creation and financial stability over time. The decision to rent or buy isn't just about monthly payments. It's about long-term financial strategy and building a secure future. So, what's the ultimate takeaway for navigating this complex landscape? The biggest takeaway is this: small changes in interest rates have massive, long-term financial consequences. Never underestimate their power. Be a diligent shopper, understand your true affordability, and consider the long-term implications of every decision, from buying points to choosing your loan type. If you're wondering what the best time to refinance an existing mortgage is, especially if rates suddenly drop, you'll definitely want to check out our video on the refinance trap, when lower rates cost you more. Subscribe now to make sure you don't miss out on more critical home buying and real estate insights.